Okay, hi guys. I hope you all are doing well. Thank you very much for your patience. So we are going to start off a session today, and the whole agenda for the session of today is going to be I would try to cover up the latest mock examination that has been published by the ACCA on their website. So what I would do is that I would try to cover up that mock examination here, and we would just try to see that we are able to cover up the mock examination in an appropriate manner. So that's what the whole agenda and whole objective of the session of today is going. So I would be using the ACCA CB practice platform, but I would be trying to answer the questions on the Microsoft Word and Microsoft Excel, because I've realized this thing that a lot of students, they ask for, especially with respect to the Excel, they ask for the Excels, and unfortunately, the ACCA CB platform, when you take a extract from that, that does not actually give you a proper detailed insight about what formulas have been applied and all that. So what I'll just do is that I would try to do it on an Excel. I know it's not very close to what you see in the examination, but still I would just go about doing it in the Excel so that you are able to see the formulas at a later stage when you want to see. Excel. Let me set up the Excel for myself also. Okay, here I go for the test reach. Okay, here you have the March 2024 examinations, mock examination that is being given to us by the ACCA. I'm just starting off that mock. Okay, now see what happens is that we get to see different things in question number one, question number two, question number three. So what I would try to do over here is that I would initially start off with the question number three, and then I would actually be going about, in fact, question number two, and then I would be going question three, and then I would be doing question number one. So the question number one would be the last question that I would be doing. Anyways, I hope that the internet does not causes any of the issues, because we have had very heavy rainfall here in Karachi, and since yesterday it's quite disturbed. I was even conducting a session yesterday for the APM, and all of a sudden I just lost my internet connectivity and I just could not rejoin in any way. And unfortunately, the session was called off in between and abruptly, and I could not just access to the students also. Anyways, so this is the mock examination that is there. For those of you who would have a question, which is, would we get the recordings for it? Yes, the recordings would be made available to you people through the WhatsApp, through the YouTube channel. So you would get it. Okay. I'm starting off with the section B, question number two. That's the first question I'm going to start off with. And we will just see that what is there in the examination, what is there with respect to this. Okay, now see, the following exhibits available on the left-hand side of the screen provide information relevant to the question. Arnison Company, potential offer for Burks Company, financial information. The information should be used to answer the question requirements within your chosen options. So this is question number two of the March 2024 mock examinations. And the requirement of this question is discuss possible sources of the synergy arising from Arneson Company's acquisition of Burks Company. So you have to actually talk about discuss the possible sources. Generally speaking, this is how we have the word processor. Okay, so I'll use the word processor here. And then it says estimate the percentage gains to the Arneson Company and the Burks Company shareholder under each of the two offers. Comment on the answers obtained. Up to 5 marks available for the discussion. So we have this requirement in here also. So we have got this part A and this part B. Now, let's just see. Let's just go about it. So let's discuss about the Arneson Company first, that what is this Arneson Company all about? Just read through the question and try to identify the key information, and we would just go about discussing it at a later stage. Okay, Arnison Company is a listed wholesale company in the grocery sector. The sector is becoming increasingly competitive as global food prices rise, but customers continue to demand lower prices. So, what is it all about? It says Arnison Company is a listed company, listed wholesale company in the grocery sector. Sector is becoming increasingly competitive and all that. So, I would just pick up the key information from here. I would say, okay, I would say it's a listed wholesale company. What is it? The key information here is a wholesale company in grocery sector. Sector is becoming increasingly competitive. Global food prices are rising. Customers continue to demand low prices. They've decided to vertically integrate into the grocery retail sector. Now see, retailing sector. So they are wholesaler and they now want to get into the retail. That's what they are planning to do. I'm just writing down these things because to me they are going to help us somewhere or the other when we would try to write down the answers at a later stage. So they are probably going to help us somewhere or the other. Okay, now let's move a bit forward and discuss about the other aspect of the question. There is a potential offer for Burks company. There is a company called Burks company whom we are actually making an offer. So there is a potential offer for Burks company. Can you read through it, please? Okay, director have identified a small chain of supermarket Burks company that could be acquired. Initial conversations between the two board of directors have been encouraging. The director of Burks company, the director of Burks company think that their shareholders will like the culture and ethos of Arnison company and would be open to the possibility of a takeover. In recent years, there have been several mergers and acquisitions in the grocery sectors, and premiums to target company shareholders have averaged approximately 20%. Okay, so the premiums have been 20%. Two alternative cash offers are being considered via the Arneson company directors, a cash offer of 2.4 per share, a share for share exchange offer of this in the combined company. Okay, so there are two alternate offers that are there. So we are going to talk about them. But what we could see is that a small chain of supermarkets, it's a small chain of supermarkets. I would pick up the key information here. A small chain of supermarkets. Expectation that shareholders will like culture and ethos of Arnes and Company. Premiums to target company have been approximately 20%. So there are few, I'm just putting up, I'm just compiling some key information so that it becomes easy, right? Okay. Now what next is there? There is basically this financial information also. And what is the financial information? So can you just go through this financial information? Okay, now it says Arnison has 100 million shares in issue trading at this per share. Its earning were 27.92 in the most recent financial year. Burks has 60 million shares in issue and its earnings were this much million in the recent financial year. As it is an unlisted company, it should be assumed that a suitable PE ratio for Burks company has 10% lower than the Arnison's PE ratio. If the acquisition is successful, directors expect that post-tax synergies of 2.98 million per year will be achieved and that the combined company's P ratio will be the same as Arnison's P ratio before acquisition. Now see, what was the requirement of the question? It says discuss the possible sources of synergy arising from Arnison company's acquisition of Burks company. See, this question, uh, this is slightly lower than the exam standard question that they have published, because in the examination the questions have a bit more detail. But still, you are good enough to actually write down the different pointers here and to write down the answer to this question. So let's try to understand. Now, see, when you are going to be talking about the different synergies, always keep your mind open. Just try to write down some pointers and then develop onto them. So, how would you write down the pointers? How would you develop onto them? Let's try to understand this. Basically, it says discuss the possible sources of the synergy. Discuss the possible sources of synergy arising from Arneson company's acquisition. Now think about it. So what happens is that one of them is a wholesaler, one of them is a listed company, and one of them is a small company. So what happens is that then plus what happens is that one of them is a wholesaler and the other one of them is a retailer. Now what's going to happen? See, the synergies, possible sources of synergy. What could synergies arise from? Number one, when you are a listed company, you are a big company. You've got access to finance easily and hence ability to expand the operations using the finance. When you are a listed company and the other company, when you are a listed company, so you are able to attract good quality human resource. Good human resource with Arneson company. Then what happens is that the margins are not leaked out in the markets, but rather retained in-house. The economy of scale is achieved as larger quantities could be bought. Plus, what else is there? The cash flow situations may improve a bit as retailing is cash rich. Now, see what happens is that there is actually nothing mentioned in the question technically, and you just have to try and make sure that you do things on your own. You just have to try and make sure that you identify things on your own. Now see how. Basically, what happens is that you would be discussing all these pointers, which is the post-tax synergies of $2.98 million are expected to arise, and these are likely going to arise due to following factors. Arneson Company is a listed company. Being a listed company, they have easy access to finance, whether from equity or through debt also. This would mean that in case of any shortfalls in the cash for the expansion of the Burks operations, Arnison will have the capability to raise finance from the market. Arnison being listed is able to attract better human resource as compared to a small business. This would mean that more competent staff can be hired and the running of the business operations could be in the hands of experienced professionals. See, you got to mention this factor also. The reason being that everything matters here. With the global competition, the customers' requirement to sell at low prices can only be met if the margins are not compromised. Here, with the vertical integration, there will be several cost savings, and such savings can be passed on to the customers without a cut in the margin, and hence increase the customer satisfactions, which in turn will lead to increase in the which in turn will lead to increase in the sales and hence profits. With the business becoming larger and there could be economies of scale with respect to warehousing, nearby retailing, supply chain discounts, etc., and hence could lead to significant cost savings. So you see, all of these things could arise. The cash flow which may get stuck in the market when the sales are made to other retailers will now be recovered a bit more quickly as the retail operations are cash rich business, and it will help the combined company to reduce its cost of working capital. You get my point? So it's a 4-mark requirement. You don't have to, it's not necessary that you write down so many pointers. I've just written out these pointers just to make sure that basically I write down whatever I can. I've just written down extra pointers just to make sure that I give more input to you people in the examination. You just have to write 4 pointers. You don't have to write all these pointers. But the thought process is needed, right? The thought process is needed. Now let's move a bit forward. I'll just delete these pointers here. Now, estimate the percentage gains to Arnison company and the Burks company shareholder under each of the 2 offers. Now, what are the 2 offers? Let's try to see. A cash offer of 2.4 per share. So, offer 1, cash offer of $2.4 per share. Then we have got offer number 2, a share for share exchange offering 4 shares in combined company in exchange for 5 shares in Burks company. Okay, share for share, 4 shares, in combined company for for 5 shares in Burke company. Okay, just a second. नहीं आलमगीर, ये तो ACCA AFM की क्लास है यार. एडेप IFRS की आज नहीं है क्लास. Okay, so there are 2 offers, which is this. Now, what do we need to do from the perspective of the examination? What is the question's requirement? Estimate percentage gains to the Arneson company and the Burks company shareholder under each of the 2 offers. So let's just try to see. Um, what is the financial information that is given? It says Arneson has 100 million shares in issue trading at 3.35 per share. So on the basis of this information, its earnings were 27.92 million in the most recent year. Okay. Before I go on to discuss these offers, I would just compile some information in here, which is about Arneson, number of shares, is 100 million, book value of share, market value of share, 3.35. Recent earnings are 27.92. This is about Arneson company, right? So we have the information about the Arneson company. Now, what about Burks company? I'll just copy the whole of it, just paste it here. So if I talk about the Burks company, the number of shares are 60 million shares. Its earnings were 11.61 in the recent financial year. Then it says in the most recent financial year, it is an unlisted company. It should be assumed that a suitable P ratio for Burks company is low, 10% lower than Arnison's P ratio. So if I talk about the price earning ratio, and if I talk about price earning ratio here also, what is the formula for the price earning ratio? It's like share price divided by EPS. It's like share price divided by EPS. So if I need to know the EPS is gonna be this earnings divided by this many shares, 0.2792. So the P ratio is share price divided by the EPS, 11.99857. 11.99857 is what the EPS is. ओके आलमगीर, आप मुझे मैसेज करें रात में, मैं आपको जवाब देता हूँ क्लास के बाद इंशाल्लाह. Okay, so this is what the EPS is, this is what the P ratio for this company is. Now what next is there? The next situation is that it says that the suitable P ratio for Bugs company is 10% lower than Arneson company's P ratio. So suitable P ratio for Bugs company is 10% lower than Arneson's P ratio. Okay, so that means the P ratio here is gonna be this multiplied by 90% because it is gonna be 10% lower. Okay, I'll slow down. Thank you for identifying that I'm fast. Okay, see. The formula for the P ratio is share price divided by EPS. Share price divided by earning per share, the EPS. How do we get the EPS? EPS is like this. The earnings, which is the profit divided by number of shares. So you get the EPS. Right? Okay. Now, the PE ratio is gonna be what? The share price divided by EPS, you get the P ratio. Share price is this, divided by EPS, you get the PE ratio. Okay, how did we get the number of shares? It is written in the question here. Yeah, do you get it now? Okay. Now, so basically, what have we got? We get this EP ratio as this. The P ratio of this company, it says that it is going to be 10% lower. 10% lower means it will become 90%. So the relevant information here is this and this. So the only calculations that I've done till now is these. Yeah, is that okay? Now see, what actually happens is that we have to try and understand that what is the examiner asking us to do. We have to try and understand what the examiner is asking us to do. He tells you that look, you have to calculate You have to calculate the estimate percentage gain to the Arnison company and Burke company shareholder under each of the two offers. So how would you calculate the percentage gain? That's important. So for, let's say, if I say Arnison company shareholder, how do I calculate the gain? I would calculate the gain like this. I would say the value of the combined company, value per share less cost paid, gain per share. How would I do these calculations? I would tell you. Now, first of all, you need to understand few things. What is going on? What is actually going on is that we are acquiring this company. And in order to acquire this company, we need to see, we need to realize that what is going to be the situation. So if I talk about Burke company shareholder, so you need to see that what is the cash received is 2.4. They're receiving cash of 2.4. Value per share gain slash loss on disposal. So you need to think about the Burke company shareholder. They own the Burke company's shares. They're getting $2.4 per share. We need to compare it with the value per share, that what is the current value of a Burke company share. Can you calculate the current value of a Burke company share? Yeah, can you calculate the current value of the Burke company share, please? Yeah, can you people calculate the value of a Burke company share? Can you calculate value of a Burke company share? Okay, let's give it a try. I will wait for 2-3 minutes because I don't want to get involved. First of all, I want you people to do it. Otherwise, you people say that I'm very fast. Okay, different answers. Okay, now let's see. See, so I'll just take you people through this. Okay, let me just show you. PE ratio has a formula, which is it is equal to share price divided by EPS. So if I talk about this Burke company, the P ratio of the Burke company is 10.7987. P ratio of Burke company is 10.7987. The share price is not known. The EPS can be calculated like this, equals to 11.61 million of earning divided by number of shares. So you've got an EPS of 0.1935. What do you have? You have an EPS of 0.1935. So how would I calculate the share price? The share price would simply be rearranging of this formula, and the share price is gonna become PE ratio multiplied by the EPS, which is gonna be 2.08995. So if you want to calculate the gain from the perspective of Burke company shareholders, they're receiving $2.4 per share. What was the value of their share? It was this. So they are actually getting this gain, 0.31045. So if we talk about the gain percentage, it is simply gonna be this gain on disposal divided by the value per share. So it's like 14.857 is what they are getting. Right? So that's one answer, because the examiner says for under each of the offer, you have to identify the how much percentage gain are they getting. For each of them, you have to establish how much percentage gain are they getting. Do you get it? Yeah, do you people get it? All of you who got things wrong, Prerarna, I don't know, I'm sorry, how is your name pronounced? Prerarna, you got it right. Thank you. Jamshed Khan, you got it right. Okay, Heller. Where are you stuck, Heller? Heller, let's just try to understand. Do you understand that what is the question asking you to do? See this question. It is asking you to calculate the percentage gains to each of the shareholder, to Arnison company shareholder, to Burke company shareholder. Now, see, I am a shareholder of Burke. Arnison tells me that, look, hello, take $2.4 per share. I would say okay. Now my question is that how much percentage gain did I get? So it's quite simple. I'm getting 2.4 per share. I need to know what is the value of my share right now. Once I know the value of my share right now, I will compare the gain and I'll get the percentage, right? Is that okay? Now, but from the examination perspective, the examiner had given you the number of shares that Burke company has. He did not give you the market value of each share, but he did give you the earnings of Burke company. And he told you one thing, that look, this Burke company's PE ratio, the price earning ratio, is 10% less than the price earning ratio of Arnison company. So what did we do? We actually used the Arnison's company price earning ratio. We multiplied that by 90%, saying that this is 90% of the previous. So we got 10.7987 as the PE ratio of Burke company. Now, we did not have the Burke company's share price. So the formula for P ratio is share price divided by EPS. This is the formula for P ratio. If you want to rearrange the formula and you want to make it a share price formula, so it is simply gonna be PE ratio multiplied by EPS. Do you get it? Now, the P ratio is given here from this scenario. It's coming in from here. The EPS, we have to calculate. EPS means earning per share, the profit divided by number of shares. So we get this EPS. So the share price is calculated, the formula of P ratio multiplied by EPS. We got 2.09 as the share price. Now I am a Burke company shareholder. I received 2.4. And the value for each company's share, my each company's share was worth 2.0895. That means I've got a gain of 0.31045 on my share. This gain is 14.9% of the existing value of the share. Do you get it now? Everyone okay now? Okay, now let's move a bit forward. Now I want you to work out that how would you calculate the gain for Arnison company. Yeah, I'm giving you 2-3 minutes. Just think about how would you get the gain for Arnison company. I'll just open this area also for you. Okay. Now what I can see is that I'm getting to see different answers. Now see, think about it. You are Arnison company. You are acquiring this company Burke. So the Burke company will finish now. Burke company will become your company now. So your company plus Burke company will be combined and the whole value would come to your shareholders. But automatically you'd pay certain amount to their shareholders also. So there's going to be a net amount that you would save. So now we need to see that how things go about. Arneson has 100 million shares in issue, trading at 3.35 per share. Its earnings were 27.92 million in the most recent financial year. Burke has 60 million in share and its earnings so and so on. If acquisition is successful, directors expect that post-tax synergies of 2.98 million per year will be achieved and that the combined company's P ratio will be the same as Arneson's P ratio before acquisition. Now that's very important. So see, try to understand here. What is going to happen? Okay, now see, what happens is that, let's talk. So let me just guide you. Now see, we have to first of all calculate the value of the combined company. How would you establish the value of the combined company? Try to understand this. Expected earnings, Arneson earnings, Burke earnings, post-tax synergies. So what is the earning of Arneson? Arneson's earning are 27.92. Burke's earning are 11.61. 2.98 million is the post-tax synergies. So the combined earnings is this. The expected earnings are these. Expected P ratio, it tells us that it is going to be equal to Arneson's current P ratio. So value of company will be, or you could say even the EPS will be the earnings divided by 100 million because the number of shares are going to be 100 million. Why the number of shares are going to be 100 million? Because you have acquired them. It's not your company's share only. EPS is going to be 0.4251. So share price is going to be P ratio multiplied by EPS. P ratio multiplied by EPS. So it's actually going to be 5.1, which is the share price of the combined company. Now see, the gain on Arneson company's shares. How? How do we calculate the gain on Arneson company share? We would calculate it like this. We would say combined company share price will be this less Arneson share price. What is the current share price of Arneson? Arneson's current share price is this less paid to Burke company shareholder 2.4. Gain or loss will be this. Gain or loss will be this. So there is actually going to be a loss. How much is going to be a loss? there's going to be a loss of 0.64941 per share. But you know what? There is going to be an issue if we calculate it like this. Why? Because ultimately what happens is that we need to establish the value of individual companies. So now let's just try to see what happens. The combined company value, I would go for combined company value because there is a problem with how it is going to be like this. 0.42 this share price multiplied by 100 million shares less Arnison value. This multiplied by number of shares because the number of shares were Burke not the same. So therefore we have to compute on the basis of combined value. 2.4 into 60. So hence 31.0591 is the gain loss and the gain percentage is gonna be this divided by Arneson share price. So you see this is what is the total gain going to be 9.23% or 27%. Now again I'm just putting it here. Can you just see what I have done? Can you just let me know if you understand what we have done? Yeah, can you please let me know if you understand what I have done here? Okay, let me just slow down. See, first of all, just try to understand. You need to calculate the value of the combined company. Do you people understand that the combined company now would mean that Arneson, Burke would become single? So that means that you would put in Arneson's earning that was 27.92 plus Burke's earning that was 11.61 plus post-tax synergy which was 2.98. So the expected earning are the sum of all these. Do you get this? Now we are expected to have a PE ratio. We are expected to have a PE ratio which is going to be the same as Arneson's current PE ratio. And if I try to calculate, I'm just telling you something. See, now it's Arneson only because Burke company is acquired. So the number of shares are going to be the same as Arneson's existing number of shares. And that is going to be 100 million. So the earnings divided by 100 million gives you EPS. And then we calculate share price using same formula, which is P ratio multiplied by EPS. Now, is anyone, I mean, just show me a thumb impression or something if you are okay with it till here. Kindly, please. Hello, are you all okay till here? Then I'll explain the gain on Arneson. Okay, sure, you can see the EPS cell. Here you go. The EPS cell is the total earnings divided by 100. Why 100? Because 100 million shares are there in Arnison company. We are talking about the cash offer right now, Jamshed. I am not talking about share for share offer, please. I am talking about cash offer. Okay, Isra Tali, just try to understand. Just try to understand. This is Burke company, right? I acquired it. I acquired 100% shares of Burke company. Now Burke company and this Arneson company now get converted into a Arneson company only because I acquired all the shares. They become my shares. See, we acquired Burke company. Their shares become our shares now. The shareholders don't remain anymore. It's just us, and us only. That's it. See, read it here. What are you doing? You're giving the cash offer. One of them, my offer is cash offer. Take cash, give me your company. That's it. Khalas. The story is ended over there. Give me your company and take cash money. No new shares issued. Their shares get cancelled. They become part of Arneson now. Okay, just think about it. When you prepare consolidated balance sheet, whose share capital do you show? Parent or subsidiary? So basically, what has happened is think about it here. I acquired that business. I acquired 100% of that business. And the 100% earning would go to the 100 million shareholders of my company. Do you get it now? Okay, lovely. Now, let's just move a bit forward. Now, just think about it. Yeah, the other company's shares are cancelled because I acquired the whole of it. It's a cash payment. Every single profit that is going to be made that goes to the shareholders who hold the 100 million shares. Every single penny that you earn that only goes to 100 million shareholders. Okay, I'm gonna come to the gain. Don't worry, don't worry, don't worry, don't worry. Yeah, this applies only when there is a cash offer, Daniel. Just don't worry. I'll come to the share for share offer also. So don't worry about it. Now, I'm telling you now what is happening. So the combined company is now 5.10059 is the value of one share. And my company has got 100 million shares. So the total value of my company would become this into this 510 million. Is that okay? Now, I need to calculate the gain from the shareholders of Arnison company. That what gain do they have? What gain have they achieved? How would we get that? See, you would get that gain like this. You would say, what is the current share? What was the value of the current business of Arnison? So 3.35. You see, 3.35 was the value of one share, and there were total 100 million shares. So therefore, 335 million was the value of Arnison company right now before acquisition. We paid 144 million to Burke company shareholders. How? 2.4 per share is what we paid, and we paid for 60 million shares. So we paid 144 million to them. Now what happens is that the sum of all this is again like we paid 144 to them. We were already worth 335. So our combined company, combined business is now worth 510. So that means we have got a gain of 31 million. Now, this 31 million gain is for us, the Arneson company shareholder, and our business was worth 335 million. So I would calculate gain like this 31 divided by 335. Do you get it now? Okay, so see, we got the gain from the perspective of this, that in case if we give cash, what will happen? Now, that was one of the requirements. Now we go on to the offer number two, share for share. What is share for share here? That means we'll issue 4 shares in combined company for 5 shares in Burke company. Okay. So what would happen? Just think about it. First of all, I'll calculate value. I'll calculate number of shares of the combined company. How do we do that? Number of shares of Burke purchased. So number of shares of Burke purchased is 60 million. You purchase 60 million shares. You purchase 60 million shares. What do you purchase? You purchase 60 million shares. So what did you purchase? You purchased 60 million shares. Now what actually happens is that the number of shares issued of Arnison. Arnison is purchasing Burke. Arnison is giving its own shares and taking Burke's share. Should say this is going to be 60 million shares divided by 5. Because for every 5 shares, we are going to issue our 4 shares. Is that okay? Shall I click the enter button now? Do you people understand? Okay. 48 million, right? Number of shares. Now, existing number of shares of Arnison is 100 million. Revised number of shares are gonna be this 48 plus 100, 148 million. Do you people get it? Okay, lovely. Now I'll not do this calculation again, which is the earnings of the combined company is gonna be, we did this earning calculation earlier. I'll just connect it from there. So earnings of the combined company is what? 42.51 million. You get my point? 42.51 million is the earnings of the combined company. Is that okay? Now, so what actually happens is that now let's try to understand. The EPS of the combined company is this earning divided by number of shares. PE ratio of combined company is 11.9986. Share price of combined company is gonna be share prices P ratio multiplied by EPS. This is what we get, 3.44635. 3.44635. Do you people understand this? Do you understand what is happening? Okay. Value of combined company is gonna be, this is share price multiplied by the revised number of share. So 510.059. Okay, now we need to calculate the gain for Arnison company and we need to calculate the gain for Burke company. Gain for Arnison company share. Revised value. Okay. Out of the 148 million shares, 100 million are owned by the original shareholders of Arnison and 48 million are owned by the shareholder of Burke. Do you understand this? The shareholders of Arnison, gain for Arnison company shareholders. The Arnison company shareholders have got 100 million shares out of 148 million. Original value of Arnison was 3.35 million into 100, 335 million. So the gain for the Arnison company shareholder is going to be this and this. The gain percentage is going to be 2.796%. Now, again, I will stop again. I don't want to be classified as a fast tutor. So there is no fast and the furious that's going on. So just try to understand. Do you understand this pointer? Okay, kindly do back. Okay, here you go. This is how you get it. Here you go. Now, can you just look at it, please? Okay. Now, um, if I say gain for Burke company shareholders, what is the revised value? 48 million shares that we have issued belong to Burke company shareholders. So the new company, the Burke company shareholders have 48 million shares. Each share is worth this much. What was the original value of Burke company? So we did calculate. Their original value was this share price multiplied by they had this many number of shares. So the gain is this minus this. The gain percentage is this gain divided by original value. So 31.946%. Okay, see here. For every Burke company shareholders, they have got 48 million shares in the revised company. And the value of each share is this. What was the original number of shares that you have? So they had 60 million shares multiplied by this original value 2.08955. The gain over here that they have got is this and this. The difference is 40 million. The gain percentage is gain divided by original value. Okay, I'm waiting now. Ask whatever questions that you have. Ask whatever questions that you have. Yeah, ask whatever questions that you have. Wherever you are stuck, ask please. Okay. Now, do you know that the Burke company shareholders, they own 48 million shares in the new company? And the share price of combined company is 3.446. Okay, just a minute, Eddie Deweyne. Just a minute. I'm sorry, I cannot pronounce your name correctly. Eddie Lee Woy, probably. Okay, anyways. So Jamshed, the revised number of shares that the Burke company shareholder will have 48 million shares multiplied by 3.44635. Is that okay for you people? Now, next is that the original value. The original value is like 60 million shares multiplied by 2.08955. So this is the gain that they have got. And this is a percentage gain. Okay. Now there was somebody who was asking a question. I don't know who was that. Eddie Doyne. You were asking a question. What do you want to know, please? You want to know this 48? How did I get 48? Do you want to know this? Original value is like going back. Let me just take you there. It's like this 60 million multiplied by 2.08955. 60 million multiplied by 2.08955. It could be done. If you want, you can do it. Believe me, you can do it. Yes, Daniel, that's why I did it on Excel. I need to share this spreadsheet. Okay, I had a plan, but I literally am realizing this thing that there is a lot that you people have to cover. And believe me, what I'm actually uh, trying to do is that I'm trying to schedule something. I'm trying to schedule some classes in the coming week with you people because literally I can see that there is a huge gap that you people have. And apparently it seems to be that you people are not that very well prepared. I'm sorry about it, but literally, I mean, like what I can feel is that there is a huge gap and lack of practice evident. I'm sorry, I'm speaking the truth. I'm sorry, but believe me, this is what I can feel. I've shared a WhatsApp community link for myself where I'll be sharing this, all of this notings and etc. But I think that we should have more sessions now. because I don't think that we can just go about doing it like this. You probably uh, it is going to be very difficult. I'm not discouraging anyone, but I'm just realizing one thing, that we need more exam practice. The reason being that you people have not practiced much, frankly, or you have not practiced much on your own. You have just practiced very few questions, or you have practiced because this is a very common type of a question from the for this mergers and acquisition. Anyways, now estimate the percentage gains to Arneson and Burks shareholder under each of the two offers. Comment on answers obtained and the position of each company shareholders. Now you see, the examiner is asking us to comment. Okay, see, whatever that you do, you could even prepare a table here, which is gonna be okay. Let's say I'm inserting this table. Shareholders, Arneson company, Burke company. Cash offer, share for share offer. So for cash offer, it was like 14.9% and 9.27%. For share, we had 2.8 and 31.95. Okay. I'll just before, I mean, like you can always elaborate, but you could just see Arneson company shareholders are getting lesser gain as compared to Burke company under both situations. So one thing is that the Arneson company's shareholders are getting lesser returns as compared to Burke company. Now what next is there? The next situation is that Burke company shareholder are getting less than 20% premium under cash offer, but a significant premium under share for share. Burke company is benefiting the most from this acquisition. Arneson is offering the offers made by Arneson will not be pleasing to their shareholders, as a greater value is passed on to the Burke company shareholders. Okay, sorry. Now, did I put the wrong value or what? I don't think I put the wrong value. Okay, now you would comment on this. Burke company shareholders will be more than willing to proceed, whereas Arnison company shareholders would resist a lot to proceed with these kind of offers. You get my point? So this is what you have to do. This is what you have to write. Is that okay now? Okay. Hmm. Yes. Yeah, it's usually good, but the point is that you need to get the benefit. I mean, like, why should the majority synergies go to them? It's not always the case. We are not there to pass on our synergies onto them, right? Okay. So we are done with this specific question, the name of which was Arneson Company. Now, guys, you see what